At this time, I'd like to welcome Kevin Kliesen into the live stream. Good morning, Kevin. How are you?
Good morning, Jeremy. Good
I'm
to be
sorry
with
for
you today.
butchering your title there. Didn't mean to do that. But it's interesting. A lot of our members are curious about what this economic outlook is going to look like, and then also how it's forecasted for the construction industry specifically. With a new administration and some vaccine dynamics, I'm sure that it's going to present a pretty challenging outlook.
Yep, the fun never ends for me.
Well, thank you again for joining us. I know that you've been to our expo a number of times and have done a number of presentations. So with that, we'll go ahead and get right to it.
Okay, sounds good. Let's see. I don't see my presentation. There we go. Oh. Can you see it?
It looks good.
Okay, good. Well, thank you again, Jeremy. And so I'm going to kind of walk through my what I think is kind of the key key developments in the economy and kind of the stress points and where I see the U.S. economy going over the next year or two. So as always, these views are my own and not necessarily those of the Federal Reserve Bank of St. Louis or the Federal Reserve System. So, I always like to start my talks by kind of giving the 30,000-foot view. It's very easy to sort of get lost in the sort of this world where the information flow is just relentless and unceasing. So we've had two what economists call shocks, global shocks over the past dozen years, the financial crisis and now the pandemic. As Jeremy mentioned, we're kind of shifting away what I call pandemic dynamics. So this is the idea of states imposing containment measures and people being fearful of going out to eat or travel, to now we're transitioning to a period what I call vaccine dynamics, where containment measures are being reduced and people are more comfortable going out and traveling. So that shift is underway. The speed of the shift started slowly, but it appears to be picking up as the vaccine doses ramp up. There's a new administration, obviously, with very different economic policies, and we kind of see that with some of the proposals being put forward. So that will, at some level, obviously affect the economy going forward. And I think just to prelude my my point, most forecasters, including myself, expect much stronger economic conditions this year, next year. There is, though, some risk of much higher inflation. So let me talk about kind of the big picture in pictures. So I'm going to show you some slides from our FRED database. If you're not familiar with FRED is Federal Reserve Economic Data. It's a database hosted at the St. Louis Fed. It's the world's largest free database, so it's priced correctly. So this is the broadest measure of economic activity, real GDP, or real gross domestic product. You can see that the decline in real GDP from the peak at the end of 2019 was just stunning. Never seen a decline like that in history. If you look at the table at the right, the decline in the second quarter was a little over 31% at an annual rate. And it's important to know these are annualized rates, so it's kind of like an annual percentage rate of an interest rate that you would be charged for a loan or that you might get for a savings deposit. So if you look at the quarterly rate, which is just simple, the quarter-to-quarter percent change, so minus 31.4% translates into minus 9%. Again, that's a very, very big decline. The economy rebounded sharply in the third quarter and continued to grow in the fourth quarter, but a much slower rate, a little over 4%. I think 5% growth is or probably even stronger is going to be something we'll see in the first quarter of this year, and the early data look pretty promising. So obviously, employment is affected tremendously by the sales of goods and services, So we saw that employment, non-farm payroll employment fell sharply once the pandemic started. It's bounced back a little bit. You can see for the red circles there that basically the decline in the pandemic wiped out almost 10 years of job gains. So again, just stunning. There was a decline in December, bounced back a little bit in January, but still employment's still about 9.8 million below the peak. So it's going to take a while to get back to where we were before the start of the pandemic. Obviously, if employment's falling, that means the unemployment is rising. And we saw the unemployment rate peak in April at a little less than 15%. If you, the Bureau of Labor Statistics, which puts out this series, said that if people had answered the survey correctly, and the unemployment rate is based on a survey of a little over 50,000 households, if people had answered the survey correctly, the true unemployment rate in April probably would have been closer to 20%. The unemployment's come back down, 6.3% in January, but if you measure the total number of people that are still receiving some form of unemployment insurance benefit, that's a little over 11% of the labor force. So the labor market is still impaired, and it's just going to take a while for it to return to something approaching normal. I think a better measure of the labor market is the employment to population ratio. And again, this is just what it sounds. It's the percentage of the population that is employed. And we're currently at about 57.5%. That's well below the peak, but again, also well below the all-time high of the series, which occurred in early 2000. So again, we have a much smaller percentage of the population working, and some of that is due to demographics as the baby boomers begin to retire. Let me look at St. Louis for a second. So this is the St. Louis metropolitan employment picture. So again, very sharp decline, but you can see that whereas the U.S. Decline in payroll employment wiped out about 10 years worth of job gains, the pandemic effectively wiped out nearly 25 years of job gains in St. Louis. So the hole for St. Louis is much deeper. So it's probably going to take longer for St. Louis to climb out of this hole than it is for the nation as a whole. If we look at the employment in St. Louis metro area by major industry, so what this chart is showing you, the light blue line is St. Louis and the darker blue line is the U.S. And basically what it's doing is showing you the percentage change in total employment and then in particular industries throughout 2020. So for example, if you look at the upper left chart for total non-farm payrolls at the depth of the pandemic, for U.S., payroll employment was down about 15% from December 2019, where it was only down about 12% for St. Louis. Now, if you look at the industry, most of the industries, we've seen stronger growth in St. Louis compared to the nation. I've highlighted the construction sector there. Construction employment in St. Louis eked out a small gain in 2020. If you look at the bottom lower left chart, the leisure and hospitality service, this is where the pandemic really took a toll on the economy. People not going out to eat, not traveling, no hockey games, no baseball games, and the decline in leisure and hospitality was just stunning. Both U.S. and St. Louis falling 22% last year. And then St. Louis had a bigger decline in government employment than did the nation as a whole. Okay, so let me talk a little bit about some construction trends. So now I'm going to return to U.S. Here the data is better and it's more timely than we see for the state and local levels. So this chart is showing you construction payroll employment. So you can see that for both res and non-res, you saw big declines during the pandemic, the shaded area there. In fact, the decline in residential employment in the residential construction industry was steeper than the non-residential industry. Both industries have bounced back, but you can see that employment in residential construction has continued to grow, and it's now surpassed its pre-pandemic level, whereas for non-residential construction employment, it's kind of tapered off a little bit, and it still remains well below its peak. So this now moves from employment to outlays. Again, and this is U.S. So you can see kind of why the diverging trends you saw in the previous chart with res and non-res. And again, there's a housing boom going on, as probably everybody knows. It's a good time to be a home seller. You can see that residential construction outlays have just skyrocketed very strongly nationwide, whereas construction outlays in the non-residential sectors have actually continued to decline throughout the pandemic. And that's despite the fact that, the shift to e-commerce has generated just a huge amount of construction in warehouse space. So this has not been enough to pull forward or pull higher non-residential construction. And then the final line is public construction. So this is state and local effectively. And you can see it really hasn't declined. It's kind of stabilized since earlier this year, in contrast to non-residential private. Okay, so this is one reason why we're seeing weakness in non-residential construction, is that offices are still in major cities almost vacant. So this chart is measuring kind of percent occupancy rates for commercial properties in 10 major U.S. cities. And basically, as of early February, about 12% of commercial office properties in these 10 major cities are occupied. So again, there's a lot of work from home. So really, and people are not sure how long this phenomenon is going to last. Is it permanent? Is it semi-permanent? So this has really, I think, put a damper on plans to build new office construction going forward. So let me turn to the public sector. This is state and local. So the top black line is total public construction spending, and it actually has been on an upward trend over the past 6 years or so, since roughly January 2014. Dipped a little bit in the pandemic and the recession recently, but it's come back a little bit. Still remains below the pre-pandemic peak. And then the other two lines show you the two largest categories of public construction outlays, and that's state and local outlays on highway and streets and education. And again, they've seen a modest uptrend over the past several years, maybe more so for education than state and local highways. But again, we haven't seen the significant declines in these two categories that we've seen in maybe some other categories. So another way to slice and dice the data is kind of focusing on those parts of state and local construction that we might think of as being total infrastructure construction. And this is the sum of education, public safety, transportation, highway and street, sewage and waste disposal, and water supply. So obviously the demand at some level for infrastructure spending is dependent on population growth. Obviously, infrastructure deteriorates, so it has to be repaired or replaced. So that's also a factor. But what this chart does is puts it in inflation-adjusted dollars, and then and measured as on a per capita basis. So you can see that there was a very sizable increase from 1995 to just after the 2001 recession, from about $600,000 per person to a little over $1 million per person. Declined during the expansion from 2001 to 2007, then picked up again, reaching an all-time high in 2009 of a little over 1.1 million. Then declined again after the recession of 2007, 2009, the financial crisis. It's since come back up a little bit, but again, it's still nowhere near the peak that we saw in late 2001 and in the middle of 2009. Okay, so this chart is my good friend Ken Simonson. Some of you may know him or know of him. He's the chief economist for the Associated General Contractors of America. And basically, they recently published a survey of their membership, and they're asking them, give us your projection of the net change in the value of projects in a particular industry or sector relative to 2020. So you can see that, and this is a national survey, and you can see there's only 3 areas where the survey, and again, this is a survey, it's not actual dollars being reported, it's just the people who responded to this, their estimate of the dollar value change in percentage terms from 2020 to 2021. So healthcare, maybe not surprisingly, warehouse, again, e-commerce, and water and sewer. Those are the 3 categories where this survey suggests we'll see higher dollar values of construction projects this year than last year. And then after that, it just declines, and in some cases declines sharply. Retail, lodging, and private office, again, this is the possibility of these permanent or semi-permanent pandemic effects. And then, you get smaller declines in manufacturing and bridge and highway and so on and so forth. Now, they also do a survey for Missouri, and it's a smaller number of participants. So you maybe not want to take these numbers so literally, just because it's a smaller survey, so you have more sampling there. But so the numbers for Missouri are in blue. And so warehouse and water and sewer, much stronger gains are expected by AJC members in 2021. Power also 18% expected to be up this year. And then finally, manufacturing expected to be up in 2021 in Missouri as well, whereas for the nation, expected to decline by 17%. And then after that, you get kind of similar percentages. Again, very large declines in private office, lodging, and retail. So again, the pandemic looks like it's going to have some longer lasting effects for construction in several areas. Okay, so another challenge that many non-residential construction firms are experiencing, as well as residential, if you're in the home building industry, you know that the prices of lumber are just going through the roof. But this chart is showing you 2 things. It's the dotted line is showing you what's called the bid price for new non-residential building construction. So you can think of this as sort of the value of the construction that's being bid. And basically, it really hasn't changed that much since April 2020. But if you look at the inputs to new non-residential construction, they're rising sharply. So from April to January 2021, based on the producer price index for the series, input prices are up by about 11%. So obviously that's a pretty sizable margin squeeze for many construction firms. So if they can't obviously pass these costs along, then obviously they'll have to take lower profits, or perhaps just not bid as much on more projects, and obviously that tends to slow economic activity as well. Okay, so let me talk about the infrastructure debate that's going on. Obviously, this is kind of a perpetual debate. Some believe that with interest rates so low, now is the time to go big or go home because borrowing costs are low. But that's really been true for the past dozen years or so. I think a key problem is that federal finances are deteriorating rapidly. So if you look at, this chart shows you federal tax receipts, outlays, and the surplus deficit since 1994. So each of the series are on a 12-month rolling sum. So any point on the chart is basically the sum of each of these over the current and previous 11 months. So you can see during the pandemic, outlays or expenditures by the government just skyrocketed in over the 12 months ending in January 2021. Outlays total 6.9 trillion. Revenues declined. They've come back a little bit, kind of flatlined, about 3.4 trillion. So obviously, with outlays increasing and revenues roughly staying the same, you get a very sizable decline in the deficit. So over the 12 months ending in January 2021, it's about 3.5 trillion. Again, just huge. The CBO, the Congressional Budget Office, came out with projections a couple weeks ago. They see a deficit this year of 2.3 trillion, and that obviously does not include any sort of subsequent legislation that the administration may be able to get through Congress. So it looks like the deficit this year is going to be much higher than 2.3 trillion. If you look at the debt to GDP, expected to be 100%. So roughly, the debt is going to be the same size of the economy this year, or last year, and this year expect to be a little bit larger than the overall size of the economy, about 102%. Okay, so one of the problems nationwide, obviously, you have mandatory spending of Social Security, Medicare, and Medicaid, and that's kind of beginning to really crowd out other forms of spending like infrastructure and defense and education. And we kind of see that at the state level. So this chart is showing you state expenditures for Medicaid and education. The left chart is showing you all U.S. states. So again, education has been declining since 1990 as a share of total expenditures, whereas Medicaid is basically doubled over this time for all 50 states. It's actually situations even starkly different for Missouri. In 1990, expenditures in Missouri for Medicaid were about 14% of all expenditures. Now it's about 38%. So a near tripling. And again, education, as we see for the nation, education expenditures have also declined as well. So again, these entitlements are really beginning to have a significant and profound effect on other forms of spending going forward. And obviously, since infrastructure is part of the discretionary part of budgeting, that is, the appropriations have to be approved each year, or in case of transportation surface acts, maybe every 5 years. This means that there's scarce dollars that other forms of private industry are competing for at the state and federal level. Okay, so let me just take a look at the economic outlook from my standpoint. I think the first thing we need to remember is uncertainty is very high. As this chart shows you, this is a measure of economic policy uncertainty put together by some academics at University of Chicago and Stanford University. And you can see that uncertainty just skyrocketed during the pandemic. And obviously, I've done some academic work in this area. And basically, when uncertainty is high, it really just causes firms to, suspend a lot of their activity. It causes them not to hire people, not to go out and spend money on capital projects, because they can't really estimate the rate of return of what an additional employee might add, or a piece of equipment might add to the business. So they just kind of wait for the smoke to clear, for uncertainty to decline before really beginning to make solid plans for spending and hiring going forward. So uncertainty is coming down, but again, it remains extremely high from an historical perspective. Financial conditions, though, look really good. This is the St. Louis Fed's financial stress index. So basically, during times when there's a lot of financial upheaval, like we saw in the global financial crisis there in the middle of the chart, this index rises sharply, and that tends to have a depressing effect not only on stock prices, but also on the overall economy as well. We saw the same thing during the pandemic. Financial conditions deteriorated sharply, but now they've come back down dramatically. I think helped along by some of the policies put in place by the Federal Reserve and some of the legislation passed by Congress, like the CARES Act. So all of that has helped financial market conditions kind of be back to normal. And this chart is designed such that anything below zero is kind of a below average level of financial stress. So again, if you follow the stock market, obviously, you know that stock prices have been setting new highs recently. Okay, inflation. Inflation means below 2%. And that's kind of, the Fed instituted inflation, 2% inflation target in 2012. And inflation by and large since then has been below 2%. Chair Powell and other senior Federal Reserve officials have basically said, look, we have a 2% target. We need to try to meet that target. And if we don't, maybe that diminishes the credibility of the Federal Reserve. So they've enacted a new strategy or framework to try to meet that 2% inflation target going forward. But with inflation low, the Fed has basically said that, as we stand now, based on the data and our forecast, the Fed's interest rate policy target is going to be basically near zero for the next roughly 3 years. So markets really don't expect, nor do Federal Reserve policymakers expect to be raising their interest rate target anytime soon. Now, this chart shows you what private forecasters are predicting. The Fed doesn't predict market interest rates. So the black line is the 10-year yield, the 3-month yield, the Treasury bill yield is a measure of short-term rates. And again, that tends to follow the Fed's interest rate target. So again, expected to be extremely low levels through the next 4 quarters. Interest rates are projected to rise modestly, but again, still remain well below what they were, say, at the end of 2018. Inflation expectations, though, are rising in part because some people believe that the Fed has its foot on the gas and it's really not going to let up on the gas anytime soon. And you combine that with a huge increase in debt that's being issued by Congress, and now the prospect of maybe even more debt going forward. This has really begun to worry some people and expect higher inflation going forward. So that could be one reason why inflation expectations over the next 5 years, which is the red line, have now surpassed 2%, or now are about just under 2.4%. Part of this, though, is oil prices have risen strongly. So inflation expectations tend to react pretty strongly to oil prices. So again, oil prices are moving higher with the expectation of stronger growth going forward this year, next year. And obviously, this is filtered into refined products like diesel and gasoline. So those are retail gas prices, which include taxes, obviously. So the circle there just shows you that the latest retail gasoline and diesel prices are now running ahead of forecasts put out by the U.S. Energy Information Agency. So when their next forecasts come out in the middle of March, I would expect to see these forecasts for gasoline and diesel prices perhaps increase a little bit. Now these prices could come back down. Part of it is a reflection of the fact that the cold snap that affected Texas and parts of Louisiana shuttered a lot of refinery capacity on there. So this could reflect just natural supply constraints. And as these refineries come back line, these prices could come back, could come back down. So we'll have to follow that pretty closely. So inflation is currently low, maybe not for very long. The probability, the odds of an inflation impulse seem pretty high to me. I think all the ingredients are there. Some of the price declines that were caused by the pandemic should reverse as the economy strengthens. Prices for lodging, hotel rates, airline fares, things like that plunged during the pandemic. And as the economy recovers, more and more people will get vaccinated and begin to travel and go out again. Those prices should begin to lift and return to normal. Commodity prices, I mentioned already, surging. And you throw in the fact that money growth is extremely high. You have rising debt and deficits, and again, the Fed is actively striving to run a hot economy to return the labor market to something more normal. I think all of these things can add up to the fact that all the ingredients for higher inflation are there. We'll just have to wait and see, though. There's very strong disinflationary forces globally that have been in play over the past dozen years or so. So I think one of the things Milton Friedman taught us is that, it takes a while. It takes a while for inflation to get going, but once it gets going, it also takes a while for it to reverse. So my narrative is that obviously the economy's kind of uneven. Some industries are doing well, some others are not. The labor market's still impaired. I think the U.S. economy is resilient, though. It's bounced back years past, and there's no reason why it can't bounce back this time. Monetary and fiscal policy is highly stimulative. So if you think about the effects of the vaccines and the behavior that would probably induce, and also the fact that a lot of households have saved a lot of money. So all of that, I think, and adding in the economic stimulus, I think there's a rational reason why we should be exuberant going forward. And this is my last chart. Obviously, one of the things that forecasters try to do is try to, think about some of the potholes that might be out there. Obviously, we've had new variants of the COVID virus, and it could be the case that new vaccines may not be lead to total or immunity. There could be partial immunity. Obviously you have the strong growth and huge deficits could cause a spike in interest rates and inflation expectations, and that would probably not be good for housing or the stock market. And then finally, an old standby is geopolitical developments. So, pick your least favorite country. So anyway, thank you very much, and look forward to any questions you might have.
Thanks again, Kevin. Yeah, there's no questions in the queue, but I do have a question. That is, it seems like the St. Louis economy, for contractors anyways, it always seems to stay just a little bit steady, even when there's some variances maybe in the U.S. and other places. And what's the reason behind that?
It's a good observation, Jeremy. I don't know the answer to that question. I think, if I were just looking at the data, I would say that kind of surprises me, just simply because labor force growth in St. Louis has been about half of what we see nationwide for the past 10 to 15 years. So I don't know offhand why that might be the case. I do think, though, if we do see this sort of substantial rebound nationally, that I think obviously that should filter into the U.S. economy as well, particularly if you get some more fiscal support flowing to state and local governments.
Yeah, and it is interesting. I mean, when people talk about, how many cranes are in the air in other cities and how there's just an explosion of growth, St. Louis maybe doesn't see that to that extent, but we always stay somewhat steady. And that's kind of the message that we get back from a number of our contractors, which in a down economy, is a good thing if we're staying steady. Yeah,
there's an old biblical proverb that says, slow and slow, steady plodding brings prosperity, and hasty speculation brings poverty. So, the slow and steady may not sound sexy, but, at the end of the day, it might be better than the alternatives.
Well, great. Kevin, we appreciate it. Thank you again for your presentation. We look forward to having somebody from the Federal Reserve Bank to present next year at our expo. And if any questions come up from our site members, and maybe you don't have time to ask it today, email those to Lee@SiteSTL, and we will forward those to Kevin and get an answer back to you. So thank you again, Kevin. And as we go into the break, right after the break, we will have a presentation from Pat Kelly. He's with the Municipal League of Metro St. Louis, and he'll talk about how some of those revenue streams with the certain municipalities in St. Louis have been down a little bit. So with that, we'll go to break and see you guys back here in about 5 minutes.